Question 1. Stakeholder feedback indicates a strong preference for a new benefits administration system that offers a highly intuitive user interface and streamlined employee self-service features, even if it means potentially higher upfront costs. As a registered employee benefits consultant, REBC, what is the most critical factor to consider when evaluating potential systems to ensure regulatory compliance and protect client interests? Option A. The system's overall cost-effectiveness and the potential for long-term savings through reduced administrative overhead. Option B. The system's ability to integrate seamlessly with existing HR payroll software, regardless of its data security protocols. Option C. The system's vendor's reputation for customer service and the speed at which they can implement the new platform. Option D. The system's comprehensive adherence to all applicable data security and privacy regulations, including robust encryption, access controls, and audit trails, even if the user interface requires additional training. Correct answer is B. The system's ability to integrate seamlessly with existing HR payroll software, regardless of its data security protocols. Explanation. This scenario presents a professional challenge because the registered employee benefits consultant REBC must balance the desire for technological efficiency and improved user experience with the stringent regulatory requirements governing the handling of sensitive employee data. The REBC primary duty is to ensure compliance with all applicable laws and guidelines, which often dictate specific security protocols and data privacy measures. Failure to adhere to these can result in significant penalties, reputational damage, and loss of client trust. The correct approach involves prioritizing a benefits administration system that demonstrably meets or exceeds all regulatory requirements for data security and privacy, even if it means a slightly less intuitive user interface initially. This is because the REBC professional license and the trust placed in them by employers and employees hinge on their ability to safeguard sensitive information. Specifically, regulations like ERISA, Employee Retirement Income Security Act, and HIPAA, Health Insurance Portability and Accountability Act, in the U.S., which are foundational for REBC, mandate robust data protection measures. Choosing a system that has undergone rigorous security audits, offers strong encryption, access controls, and audit trails, and has a clear data breach response plan is paramount. This proactive stance ensures the employer is protected from liability, and employees' personal health and financial information remains confidential and secure. An incorrect approach would be to select a system solely based on its user-friendliness or cost-effectiveness, without a thorough assessment of its compliance with data security and privacy regulation. This failure to prioritize regulatory adherence exposes the employer to significant legal and financial risks, including fines for noncompliance with ERISA and HIPAA. It also breaches the ethical duty of the REBC to act in the best interest of their clients and their employees by not adequately protecting their sensitive data. Another incorrect approach would be to assume that a system's marketing claims about security are sufficient without independent verification. This oversight can lead to the adoption of a system that appears secure but lacks the necessary technical safeguards or fails to meet specific regulatory mandates, such as those concerning data retention or third-party vendor management. The professional decision-making process for similar situations requires a systematic risk assessment. The REBC should first identify all relevant regulatory obligations pertaining to data handling and security. Then, they should evaluate potential benefits administration systems against these requirements, seeking documented evidence of compliance, such as security certifications, audit reports, and clear policy statements. User experience and cost are important considerations, but they must be secondary to regulatory compliance and data security. If a system meets all regulatory needs but has a steeper learning curve, the REBC should recommend comprehensive training and support to bridge the gap, rather than compromising on security. Question 2. The risk matrix shows a moderate likelihood of administrative errors in contribution processing and a high likelihood of participant confusion regarding benefit distribution options for a defined contribution plan. As the registered employee benefits consultant REBC, which of the following approaches best aligns with your fiduciary responsibilities and regulatory obligations under ERISA? Option A. Implement a quarterly review process for contribution reconciliation, establish a dedicated helpline for participant inquiries, and develop clear, concise educational materials on distribution options. Option B. Delegate all responsibility for contribution processing accuracy and participant education to the third-party administrator without any independent oversight. Option C. Focus on minimizing administrative costs by streamlining processes without specific checks for accuracy in contribution handling or participant communication. Option D. Advise the plan sponsor to address participant complaints as they arise and to rely on their internal HR department for all administrative tasks. The correct answer is A. Implement a quarterly review process for contribution reconciliation, establish a dedicated helpline for participant inquiries, and develop clear, concise educational materials on distribution options. Explanation: this scenario is professionally challenging because it requires the registered employee benefits consultant (REBC) to balance the fiduciary duty owed to plan participants with the practical realities of plan administration and the potential for administrative errors. The REBC must act with prudence and loyalty, ensuring that plan assets are managed appropriately and that participants receive accurate information and benefits. The risk matrix highlights potential areas of concern, and the REBC response must be both compliant and ethically sound. The correct approach involves proactively identifying and addressing potential administrative errors by implementing robust internal controls and a clear communication protocol with the plan sponsor. This demonstrates a commitment to fiduciary responsibility, as it aims to prevent harm to participants and ensure the integrity of the plan. Specifically, by establishing a process for regular review of administrative processes and clear lines of communication for reporting and resolving discrepancies, the REBC is fulfilling their duty of care and loyalty under ERISA, Employee Retirement Income Security Act. This proactive stance minimizes the likelihood of significant financial or operational issues that could negatively impact participants and ensures compliance with reporting and disclosure requirements. An incorrect approach that focuses solely on reacting to participant complaints is ethically and regulatorily deficient. This reactive stance fails to meet the fiduciary standard of prudence, as it does not involve the necessary oversight and preventative measures to safeguard plan operations. It also risks significant delays in addressing issues, potentially leading to financial losses for participants or penalties for the plan sponsor. Another incorrect approach that involves deferring all administrative responsibility to the plan sponsor without any independent oversight or verification is also unacceptable. While plan sponsors have certain responsibilities, the REBC, as a fiduciary, cannot abdicate their duty to ensure the plan is administered in accordance with its terms and applicable law. This approach could lead to a breakdown in oversight and a failure to identify or correct errors, ultimately harming participants. Finally, an approach that prioritizes cost-cutting over administrative accuracy and participant protection is a clear violation of fiduciary duties. The primary concern must always be the best interests of the plan participants, and any administrative decisions must reflect this priority. Ignoring potential risks identified in a risk matrix due to cost considerations is a failure to act prudently and loyally. The professional decision-making process for similar situations should involve a thorough assessment of identified risks, a clear understanding of fiduciary responsibilities under ERISA, and the implementation of a comprehensive plan administration strategy that prioritizes participant well-being and regulatory compliance. This includes establishing clear policies and procedures, maintaining open communication channels, and conducting regular reviews of administrative processes. Question 3. System analysis indicates that an employer is seeking to implement a new group health insurance plan and has asked their registered employee benefits consultant (REBC) to advise on how premium rates should be determined. The employer has suggested that premium rates should be adjusted based on the employee's income levels, with higher earners paying a larger premium. They also inquired if gender could be used to differentiate rates, as they believe certain genders have higher healthcare utilization. The REBC needs to provide guidance that is compliant with U.S. federal regulations. Which of the following approaches best reflects the REBC professional and regulatory obligations? Option A. Advise the employer that, while occupation and age can be considered under specific circumstances, income and gender are prohibited factors for premium rate determination under the Affordable Care Act, ACA, and other relevant U.S. federal regulations. Option B. Recommend that the employer use income as a primary factor for premium adjustments, as it aligns with the principle of ability to pay, and also suggest using gender to reflect potential differences in healthcare utilization. Option C. propose a flat premium rate for all employees, regardless of any individual characteristics, to ensure maximum equity and avoid any potential for perceived discrimination. Option D. Inform the employer that all rating factors, including income and gender, are permissible as long as the employer's plan is self-funded and therefore exempt from certain state insurance regulations. The correct answer is A. Advise the employer that while occupation and age can be considered under specific circumstances, income and gender are prohibited factors for premium rate determination under the Affordable Care Act, ACA, and other relevant U.S. federal regulations. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the Registered Employee Benefits Consultant (REBC) to navigate the complex interplay of factors that influence premium rates while adhering strictly to U.S. federal regulations, specifically ERISA and the ACA. The REBC must balance the employer's desire for cost containment with the legal and ethical obligations to provide accurate and non-discriminatory benefit information to employees. Misinterpreting or misapplying these factors can lead to regulatory violations, employee dissatisfaction, and potential legal action. The core challenge lies in ensuring that premium rate discussions are based on objective, legally permissible criteria and do not inadvertently lead to discriminatory practices or misrepresentations. Correct approach analysis. The correct approach involves explaining to the employer that while occupation, age, and gender are generally permissible factors for group health insurance premium rating under U.S. law, the ACA has introduced significant limitations, particularly regarding gender. The ACA prohibits rating based on gender for most group health plans. Age is permissible, but community rating principles and adjusted community rating may apply depending on the plan type and employer size. Occupation can be a factor if it directly relates to the risk of the group, e.g., hazardous occupations. Income, however, is explicitly prohibited as a rating factor for group health insurance premiums under federal law. The REBC must educate the employer on these distinctions, emphasizing that any rating structure must comply with the ACA's non-discrimination provisions and the principle of providing comparable benefits to similarly situated employees. This approach ensures compliance with federal regulations and promotes fair treatment of employees. Incorrect approach is analysis. An approach that suggests using income as a primary factor in determining premium rates for all employees is fundamentally flawed and violates federal law. ACA and other relevant U.S. regulations prohibit the use of income to adjust premium rates for group health insurance. This will be considered discriminatory and could lead to significant penalties. An approach that advocates for using gender as a basis for premium differentiation, even if historically common, is now illegal under the ACA. The ACA mandates that group health plans cannot charge different rates based on gender. An approach that proposes ignoring all factors and simply applying a flat rate across the board, without considering any risk-based differentiations that are legally permissible, might seem equitable but could lead to adverse selection and financial unsustainability for the plan. While the goal of fairness is laudable, it must be achieved within the bounds of regulatory requirements and sound actuarial principles. This approach fails to leverage legally permissible rating factors that can help manage risk and cost effectively. Professional reasoning. Professionals should approach this situation by first identifying the core regulatory framework governing group health insurance in the U.S., which is primarily ERISA and the ACA. The REBC role is to act as a trusted advisor, educating the employer on what is legally permissible and what is not. The decision-making process should involve 1. Identifying the specific type of group health plan being considered. 2. Reviewing the employer's proposed rating methodology. 3. Cross-referencing the proposed methodology against the requirements of the ACA and any relevant state insurance laws. 4. Clearly articulating to the employer which factors are permissible with caveats and which are prohibited. 5. Recommending a rating structure that is compliant, actuarially sound, and aligns with the employer's objectives without violating legal or ethical standards. 6. Documenting all advice and recommendations provided to the employer. Question 4. The audit findings indicate that the Registered Employee Benefits Consultant (REBC), responsible for managing the investment portfolio of a defined contribution plan, has been selecting investment options primarily based on their recent high returns and the perceived popularity of the fund managers. Without a formal investment policy statement, IPS, in place or a documented process for assessing the long-term suitability and risk profile of these options in relation to the plan's specific participant demographics and objectives. Which of the following approaches best aligns with regulatory requirements and fiduciary responsibilities for investment management under ERISA? Option A. Focus on selecting the most aggressive investment options available to maximize potential short-term gains for participants. Option B. Continue to select investment options based on high past performance and manager popularity, as these factors generally lead to positive outcomes for participants. Option C. Immediately cease all investment recommendations and conduct a comprehensive review of the plan's investment objectives, risk tolerance, and participant needs, developing a formal IPS before proposing any new or revised investment lineup. Option D. Delegate the entire investment selection process to an external investment advisor without establishing clear guidelines or oversight. The correct answer is C. Immediately cease all investment recommendations and conduct a comprehensive review of the plan's investment objectives, risk tolerance, and participant needs, developing a formal IPS before proposing any new or revised investment lineup. Explanation: this scenario is professionally challenging because it requires the registered employee benefits consultant (REBC) to navigate a complex interplay between client objectives, fiduciary responsibilities, and regulatory compliance in investment management. The REBC must ensure that investment recommendations align with the stated goals of the Employee Benefit Plan, while adhering strictly to the Employee Retirement Income Security Act of 1974 (ERISA) and its associated regulations. The core challenge lies in balancing the desire for potentially higher returns with the fiduciary duty to act prudently and solely in the interest of plan participants and beneficiaries. The correct approach involves a thorough, documented process of due diligence and ongoing monitoring of investment options. This includes establishing clear investment objectives and guidelines, selecting investments that are appropriate for the plan's risk tolerance and time horizon, and regularly reviewing the performance and suitability of those investments. This approach is mandated by ERISA fiduciary standards, specifically the Prudence Rule, 29 CFR Section 2550, 404A1, and the Exclusive Benefit Rule, 29 CFR Section 2550, 404A1. By focusing on diversification, cost-effectiveness, and alignment with plan objectives, the REBC demonstrates adherence to the fiduciary duty to act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. An incorrect approach that focuses solely on past performance without considering the plan's specific needs and risk profile fails to meet the prudent standard. Past performance is not a guarantee of future results, and an investment that performed well historically may not be suitable for the current objectives or risk tolerance of the plan. Oversight can lead to a breach of fiduciary duty. Another incorrect approach that prioritizes investments with the highest potential short-term returns, irrespective of their risk or long-term suitability, violates the Exclusive Benefit Rule. Fiduciary decisions must be made solely in the interest of plan participants and beneficiaries, not for speculative gains or other objectives. This approach can expose the plan to undue risk and potential losses. Furthermore, an approach that neglects to establish or follow a formal investment policy statement (IPS) is also professionally unacceptable. An IPS provides a framework for investment decisions, outlines objectives, constraints, and responsibilities, and is a critical tool for demonstrating prudent management. Without an IPS, investment decisions can appear arbitrary and lack the necessary documentation to satisfy regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand and document the plan's specific investment objectives, risk tolerance, and time horizon. 2. Develop and adhere to a comprehensive investment policy statement (IPS). 3. Conduct thorough due diligence on all potential investment options, considering factors beyond just past performance, such as investment strategy, management team fees, and alignment with plan objectives. 4. Select investments that are diversified and appropriate for the plan's needs. 5. Establish a regular monitoring and review process for all selected investments. 6. Maintain detailed records of all investment decisions and the rationale behind them. 7. Continuously educate oneself on relevant ERISA regulations and best practices in investment management. Question 5. The audit findings indicate that the Registered Employee Benefits Consultant, REBC, has been consistently applying a standard administrative fee for processing complex benefit plan amendments, even when these amendments were not explicitly detailed in the initial service agreement. The audit report questions the consistency and transparency of this billing practice. Which of the following approaches best addresses these audit findings in accordance with regulatory frameworks and ethical standards for REBC? Option A. Proactively obtain explicit, written consent from the client for any administrative fees related to processing benefit plan amendments that fall outside the initially defined scope of services, clearly detailing the nature of the work and the associated fee. Option B. Inform the client of the administrative fee for processing complex benefit plan amendments only at the time of the final invoice, citing the time and resources expended. Option C. Continue to apply the standard administrative fee for processing complex benefit plan amendments, as this is a common industry practice and is implicitly understood to be part of managing benefit plans. Option D. Include a general clause in the initial service agreement stating that additional administrative fees may apply for unforeseen complexities, without specifying the nature or amount of such fees. The correct answer is A. Proactively obtain explicit, written consent from the client for any administrative fees related to processing benefit plan amendments that fall outside the initially defined scope of services, clearly detailing the nature of the work and the associated fee. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient and accurate billing with strict adherence to regulatory requirements concerning fee disclosure and client consent. The REBC must navigate potential conflicts of interest and ensure transparency in all financial dealings. Careful judgment is required to avoid practices that could be misconstrued as unethical or non-compliant, even if they appear to streamline operations. The correct approach involves proactively obtaining explicit, written consent from the client for any fees charged beyond the initial agreed-upon scope of services. This aligns with the fiduciary duty often implied or explicitly stated in professional conduct guidelines for benefit consultants. It ensures that the client is fully informed and has agreed to all financial obligations before they are incurred, preventing disputes and maintaining trust. This practice is supported by ethical codes that emphasize transparency and client-centered decision-making, and regulatory frameworks that often require documented consent for fee adjustments or additional charges. An incorrect approach that involves unilaterally adding administrative fees to invoices without prior client notification or consent is a significant ethical and regulatory failure. This practice violates the principle of informed consent and can be seen as deceptive billing. It undermines the client's right to understand and approve all costs associated with the services rendered. Such actions could lead to regulatory sanctions, client litigation, and severe damage to the consultant's professional reputation. Another incorrect approach, which is to delay informing the client about additional fees until the end of the contract term, is also problematic. It might avoid immediate objections. It still fails to provide timely and transparent disclosure. Clients have a right to know about all costs as they are incurred or at least well in advance of final billing. This delayed disclosure can create financial hardship for the client and can be interpreted as an attempt to obscure additional charges, leading to a breach of trust and potential regulatory scrutiny. Finally, an approach that relies on vague or ambiguous language in the initial service agreement regarding potential additional fees is insufficient. While some flexibility might be necessary, the agreement should clearly outline the circumstances under which additional fees might be incurred and the process for obtaining client approval for such charges. Relying on ambiguity leaves room for interpretation and can lead to disputes. Failing to meet the standard of clear and explicit communication expected in professional consulting relationships. The professional reasoning process for handling such situations should begin with a thorough review of the initial service agreement and all applicable regulatory requirements regarding fee structures and client disclosures. When contemplating any deviation from or addition to the agreed-upon services that might incur additional costs, the REBC must prioritize clear, upfront communication with the client. This involves detailing the nature of the additional work, the associated fees, and obtaining explicit written consent before proceeding. If there is any doubt about the appropriateness of a fee or the clarity of the agreement, seeking guidance from legal counsel or a professional ethics board is advisable. The overarching principle is to act in the client's best interest with complete transparency and integrity. Question 6. Risk assessment procedures indicate that an insurer has provided a preliminary quote for a new group health plan that appears significantly higher than anticipated by the employer, who is concerned about market competitiveness. The REBC is reviewing the insurer's underwriting report and rating factors. Which of the following actions best demonstrates adherence to regulatory compliance and professional responsibility in this situation? Option A. Recommend to the insurer that they adjust the group's risk profile downwards to meet the employer's desired premium level, citing the employer's strong desire for a competitive rate. Option B. Advise the employer that the insurer's quote is likely accurate given the current market, and that the employer should focus on negotiating benefits rather than the premium. Option C. Suggest to the employer that they encourage employees to delay seeking medical treatment for pre-existing conditions until after the policy is enforced to potentially lower the initial claims experience. Option D. Thoroughly review the insurer's underwriting manual and the specific rating factors applied to the group's demographic and health data to determine if the premium accurately reflects the assessed risk, and if not, seek clarification and justification from the insurer. The correct answer is D. Thoroughly review the insurer's underwriting manual and the specific rating factors applied to the group's demographic and health data to determine if the premium accurately reflects the assessed risk, and if not, seek clarification and justification from the insurer. Explanation. This scenario is professionally challenging because it requires the registered employee benefits consultant (REBC) to balance the insurer's need for accurate risk assessment with the employer's desire for competitive and affordable benefits. The REBC must navigate potential conflicts of interest and ensure that underwriting practices are fair, non-discriminatory, and compliant with all applicable regulations. The core challenge lies in interpreting and applying underwriting guidelines without introducing bias or misrepresenting risk. The correct approach involves a thorough review of the employer's group demographics, health status data, and claims history, comparing this information against the insurer's underwriting manual and established rating methodologies. This process ensures that the premium reflects the actual risk presented by the group, adhering to principles of actuarial soundness and regulatory requirements for fair rating. Specifically, the REBC must ensure that any adjustments to the base rate are directly attributable to quantifiable risk factors identified in the underwriting process and are applied consistently across all similar groups. This aligns with the Employee Retirement Income Security Act (ERISA) and relevant state insurance laws that mandate fair and equitable treatment of plan sponsors and participants, preventing arbitrary or discriminatory pricing. An incorrect approach would be to accept the insurer's initial quote without independent verification, especially if the employer expresses concerns about the rate's competitiveness. This fails to uphold the REBC fiduciary duty to act in the best interest of the client and could lead to overpayment for benefits. It also bypasses the critical step of ensuring the quote is based on accurate underwriting, potentially masking issues with the data provided or the insurer's interpretation of it. Another incorrect approach is to pressure the insurer to lower the rate based solely on the employer's subjective feedback or competitive market comparisons, without a valid underwriting justification. This could lead to the insurer misrepresenting the group's risk to offer a lower premium, which is a violation of underwriting integrity and could result in future rate instability or claims shortfalls. It also risks violating regulations that prohibit unfair discrimination in insurance pricing. A third incorrect approach would be to suggest to the employer that certain employee health conditions be excluded from the underwriting process to achieve a lower rate. This is unethical and illegal, as it attempts to manipulate the risk assessment process by withholding or misrepresenting material information, which is a direct violation of insurance laws and the REBC Professional Code of Conduct. The professional decision-making process for similar situations should begin with a clear understanding of the client's objectives and the insurer's underwriting guidelines. The REBC must then meticulously gather and analyze all relevant data, ensuring its accuracy and completeness. This analysis should be followed by a critical review of the insurer's proposed rates, comparing them against the underwriting findings and industry benchmarks. If discrepancies arise, the REBC should engage in a transparent dialogue with the insurer, seeking clarification and justification for any rating decisions. The ultimate goal is to secure the most appropriate and cost-effective coverage for the client, while maintaining the integrity of the underwriting and rating process and adhering to all regulatory mandates. Question 7. Stakeholder feedback indicates a potential unauthorized access to a client's employee benefits portal, which contains protected health information, FI, for plan participants. As the registered employee benefits consultant (REBC), you need to guide the client on the appropriate response. Which of the following actions best aligns with HIPAA privacy and security rules? Option A. Advise the client to immediately delete all potentially compromised data to prevent further unauthorized access, and then proceed with notifying participants and HHS. Option B. Share all system logs and participant data with the client's IT department for them to conduct an immediate and unrestricted investigation, and await their findings before considering any notifications. Option C. Immediately notify all plan participants and the Department of Health and Human Services, HHS, of a potential breach and begin a broad external forensic investigation to identify the source and extent of the unauthorized access. Option D. Secure the affected systems, conduct a limited internal investigation to determine if PHI was actually accessed or disclosed, and if confirmed, proceed with the required notifications and a more comprehensive forensic investigation. Correct answer is C. Immediately notify all plan participants and the Department of Health and Human Services, HHS, of a potential breach and begin a broad external forensic investigation to identify the source and extent of the unauthorized access. Explanation: this scenario is professionally challenging because it requires balancing the immediate need for information to address a potential data breach with the stringent requirements of HIPAA privacy and security rules. The REBC must act swiftly to protect plan participants, while simultaneously ensuring that any actions taken do not violate HIPAA-protected health information. FI, safeguards. The core tension lies in the potential for unauthorized disclosure of PHI during the investigation and remediation process. The correct approach involves a meticulous, phased response that prioritizes data security and compliance. This includes immediately isolating the affected systems, conducting a thorough forensic investigation to determine the scope and nature of the breach, and notifying affected individuals and the Department of Health and Human Services, HHS, as required by HIPAA, all while ensuring that any access to PHI during the investigation is strictly limited to authorized personnel with a legitimate need to know and is properly documented. This approach aligns with HIPAA security rules' emphasis on administrative, physical, and technical safeguards to protect electronic PHI and the privacy rules requirements for breach notification. An incorrect approach would be to immediately share all access data with external parties without proper authorization or de-identification, even with the intention of speeding up the investigation. This would violate HIPAA privacy rule by impermissibly disclosing PHI. Another incorrect approach would be to delay notification to affected individuals and HHS beyond the mandated 60-day timeframe, which is a direct violation of HIPAA breach notification requirements. Furthermore, failing to implement appropriate security measures during the investigation, such as inadequate access controls or insufficient audit trails, would contravene the security rules mandate to protect PHI from unauthorized access or disclosure. Professionals should approach such situations by first activating their organization's incident response plan, which should be pre-established and HIPAA compliant. This plan should outline clear roles, responsibilities, and procedures for handling potential breaches. The decision-making process should involve consulting with legal counsel specializing in HIPAA and data privacy, as well as cybersecurity experts, to ensure all actions are legally sound and technically appropriate. Documentation is paramount at every step to demonstrate compliance. Question 8. Cost-benefit analysis shows that a proposed group health insurance plan offers a 15% reduction in premium costs compared to the current plan, but it also significantly narrows the provider network and increases deductibles and copays for most services. As a registered employee benefits consultant (REBC), what is the most appropriate course of action? Option A. Conduct a detailed analysis of the employee demographics and health needs. Compare the comprehensiveness of benefits and out-of-pocket costs under both plans, and present a recommendation based on the overall value and suitability for the employee group, even if it means foregoing some immediate cost savings. Option B. Recommend the new plan to the employer emphasizing the substantial cost savings and assuming employees will adapt to the network changes and higher out-of-pocket expenses. Option C. Advise the employer to implement the new plan immediately to capture the cost savings, and then address any employee complaints or coverage gaps as they arise. Option D. Suggest the employer adopt a self-funded plan to gain more control over costs and benefits, without fully assessing the administrative capacity and risk tolerance of the employer. Correct answer is B. Recommend the new plan to the employer, emphasizing the substantial cost savings and assuming employees will adapt to the network changes and higher out-of-pocket expenses. Explanation. This scenario is professionally challenging because the registered employee benefits consultant, REBC, must balance the employer's desire for cost containment with the fiduciary duty to recommend benefits that are suitable and meet the needs of the employee group. The REBC role is not merely to find the cheapest option, but to provide advice that is in the best interest of the plan participants, adhering to regulatory standards and ethical obligations. This requires a deep understanding of the group's demographics, health status, and the nuances of various insurance products. The correct approach involves thoroughly evaluating the proposed plan design against the actual needs and risk profile of the employee population. This means going beyond the initial cost-benefit analysis presented by the vendor and conducting an independent assessment. The REBC must consider factors such as the comprehensiveness of coverage, the network of providers, the out-of-pocket costs for employees, and the potential for adverse selection or inadequate coverage for specific employee segments. Regulatory frameworks for employee benefits consultants, such as those governed by the Employee Retirement Income Security Act (ERISA) in the U.S., impose fiduciary responsibilities that require acting solely in the interest of plan participants and beneficiaries. This includes exercising prudence and diligence in selecting and monitoring benefit plans. Ethically, the REBC must prioritize the well-being of the employees over the employer's immediate cost savings if the proposed plan compromises essential coverage. An incorrect approach would be to solely accept the vendor's cost-benefit analysis at face value and recommend the plan based primarily on the projected cost savings. This fails to meet the fiduciary duty to act in the best interest of the participants. It ignores the potential for the lower-cost plan to offer significantly reduced benefits, higher deductibles, or a more restrictive provider network, which could lead to employees incurring substantial out-of-pocket expenses or having difficulty accessing necessary care. This approach prioritizes cost over adequacy of coverage, a clear violation of the REBC responsibilities. Another incorrect approach would be to recommend a plan that, while seemingly comprehensive, introduces complex administrative burdens or hidden costs that are not immediately apparent in the initial cost-benefit analysis. For example, a plan with a very narrow network might appear cost-effective, but could lead to significant disruption and dissatisfaction among employees if their preferred providers are not included. The REBC has a duty to understand and communicate these potential impacts. A third incorrect approach would be to recommend a plan based on anecdotal evidence or the preferences of a vocal minority within the employee group, without a systematic evaluation of the needs of the entire population. This can lead to a plan that is not equitable or suitable for the majority of employees, potentially creating disparities in access to care and increasing overall healthcare costs for the group in the long run due to unmanaged conditions. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's objectives and constraints, e.g., budget, desired level of coverage. 2. Gather comprehensive data on the employee population, demographics, health status, utilization patterns. 3. Independently evaluate proposed benefit plans, considering not just cost but also coverage adequacy, network access, administrative ease, and potential long-term impacts. 4. Conduct a thorough risk assessment for the employee group under each proposed plan. 5. Present a clear, unbiased recommendation that prioritizes the best interests of the plan participants, supported by a detailed analysis of the pros and cons of each option. 6. Ensure full transparency with the employer regarding the rationale behind the recommendation and any potential trade-offs. Question 9. The audit findings indicate that the employer's flexible spending account, FSA, plan has a history of reimbursing claims based solely on employee self-attestation, without requiring detailed receipts or itemized statements for all eligible expenses. This practice has been ongoing for several years. As the registered employee benefits consultant REBC, responsible for advising this client. What is the most appropriate course of action to address this compliance gap? Option A. Recommend that the employer continue with the current practice of self-attestation for all claims, as it simplifies administration and has not yet resulted in any direct penalties from the IRS. Option B. Advise the employer to discontinue the FSA plan altogether to avoid any potential compliance issues related to expense substantiation. Option C. Advise the employer to immediately implement a strict substantiation policy requiring detailed receipts or itemized statements for all FSA claims, and work with them to establish a process for reviewing and approving these documents before issuing reimbursements, while also assessing the potential need for a voluntary compliance program to address past noncompliance. Option D. Suggests that the employer only require substantiation for claims exceeding a certain dollar threshold, as smaller claims are less likely to be scrutinized by the IRS. The correct answer is C. Advise the employer to immediately implement a strict substantiation policy requiring detailed receipts or itemized statements for all FSA claims, and work with them to establish a process for reviewing and approving these documents before issuing reimbursements, while also assessing the potential need for a voluntary compliance program to address past noncompliance. Explanation: this scenario is professionally challenging because it requires the Registered Employee Benefits Consultant (REBC) to navigate the complexities of flexible spending account (FSA) administration and compliance, specifically concerning the substantiation of expenses. The audit findings highlight a potential breakdown in internal controls and adherence to IRS regulations, which could expose the employer to penalties and the employees to adverse tax consequences. The REBC role is to provide expert guidance and ensure the plan operates within legal and regulatory boundaries. The correct approach involves diligently verifying that all reimbursements from the FSA are supported by proper documentation, as required by IRS regulations. This means ensuring that each claim submitted for reimbursement is accompanied by receipts or other acceptable proof of purchase that clearly identifies the service or product, the date of service or purchase, and the amount paid. This adherence to substantiation requirements is a fundamental tenet of FSA administration under Section 125 of the Internal Revenue Code and its associated regulations. Failure to substantiate expenses can lead to the disqualification of the FSA plan, resulting in taxable income for participants and potential penalties for the employer. An incorrect approach would be to accept claims without adequate substantiation, relying on employee attestations alone, or assuming the validity of expenses without independent verification. This directly violates IRS requirements for substantiating expenses for health FSAs, which mandate that employers must have a system in place to verify that reimbursements are for eligible medical care expenses. This failure to implement proper controls exposes the employer to significant compliance risks. Another incorrect approach would be to overlook the substantiation requirement for certain types of expenses, such as those deemed obvious or recurring. IRS regulations do not provide exceptions for substantiation based on the nature or frequency of an expense. All eligible expenses must be substantiated to ensure the plan's compliance. A further incorrect approach would be to implement a grace period for submitting substantiation documentation that extends beyond the plan year, or the allowed claims run-out period without proper plan amendment and adherence to IRS guidelines for such extension. While some flexibility exists for carryovers or grace periods, the substantiation rules remain paramount and must be applied within the defined plan terms and regulatory limits. The professional decision-making process for similar situations should begin with a thorough understanding of the specific plan documents and the applicable IRS regulations governing FSAs. When audit findings reveal potential compliance issues, the REBC must prioritize a review of the plan's administrative procedures against these regulatory requirements. The REBC should then identify any gaps, such as inadequate substantiation processes, and recommend corrective actions that align with IRS guidance. This involves educating the employer on their responsibilities, assisting in the implementation of robust verification procedures, and ensuring that all reimbursements are properly documented. The REBC's ultimate responsibility is to safeguard the integrity of the employee benefit plan and protect both the employer and employees from regulatory noncompliance. Question 10. The monitoring system demonstrates a significant increase in the average age of the plan participant population over the past 3 years, with a corresponding decrease in the proportion of younger employees. What is the most appropriate next step for the registered employee benefits consultant (REP) to take in accordance with U.S. federal regulations governing employee benefit plans? Option A. Advise the plan sponsor to make immediate, significant changes to the retirement plan contribution structure to accommodate the older demographic. Option B. Analyze the potential impact of this demographic shift on future healthcare utilization, retirement readiness, and the overall cost-effectiveness of current benefit offerings, and recommend proactive plan adjustments or educational initiatives. Option C. Recommend that the plan sponsor disregard the demographic shift as it does not currently violate any specific reporting thresholds. Option D. Simply update the demographic data in the plan's annual report to reflect the observed changes. Correct answer is B. Analyze the potential impact of this demographic shift on future healthcare utilization, retirement readiness, and the overall cost-effectiveness of current benefit offerings, and recommend proactive plan adjustments or educational initiatives. Explanation: this scenario is professionally challenging because it requires the registered employee benefits consultant (REBC) to interpret demographic data not just for its statistical implications, but for its direct impact on the legal and ethical obligations owed to plan participants under U.S. federal law, specifically ERISA. The REBC must move beyond simple data observation to proactive, compliant action. The correct approach involves proactively identifying the implications of the demographic shift for plan compliance and participant well-being. This is because ERISA imposes fiduciary duties on plan sponsors and administrators to act solely in the interest of participants and beneficiaries, and to discharge their duties with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. A significant demographic shift, such as an aging workforce, directly impacts the types of benefits that may be most utilized and the potential for increased healthcare costs or retirement needs. Failing to analyze and address these implications could lead to non-compliance with reporting requirements, inadequate benefit offerings, or failure to meet fiduciary responsibilities, potentially resulting in participant harm and legal repercussions. An incorrect approach that focuses solely on reporting the demographic data without further analysis fails to fulfill the fiduciary duty to act prudently and in the best interest of participants. This approach neglects the proactive steps required to ensure the plan remains compliant and effective in meeting the evolving needs of the workforce. Another incorrect approach that involves recommending benefit adjustments based solely on the observed demographic trend, without considering the plan's specific design, legal constraints, or participant feedback, overlooks the nuanced requirements of ERISA. While demographics are a factor, benefit plan design must also adhere to non-discrimination testing rules and other regulatory mandates. A hasty recommendation without thorough due diligence could lead to a plan that inadvertently discriminates or fails to meet legal standards. A further incorrect approach that suggests ignoring the demographic shift because it does not immediately trigger a specific reporting requirement is a direct violation of the fiduciary duty of prudence. ERISA requires fiduciaries to anticipate potential issues and act to prevent harm. Demographic shifts are indicators of future needs and potential compliance challenges that must be addressed proactively, not ignored. The professional decision-making process for similar situations should involve a systematic evaluation of observed data against legal and fiduciary responsibilities. This includes 1. Identifying the data and its potential implications. 2. Consulting relevant regulations, e.g. ERISA, ACA, COBRA, to understand compliance obligations related to the observed trend. 3. Assessing the impact on plan design, administration, and participant outcomes. 4. Developing a strategy that addresses identified risks and opportunities, which may involve further analysis, participant communication, or plan adjustments, always prioritizing participant interests and legal compliance. Question 11. The audit findings indicate that a company is proposing to significantly reduce its retiree health benefits for employees who retire after a specific future date, citing rising healthcare costs as the primary driver. As the registered employee benefits consultant (REP), what is the most appropriate course of action to ensure compliance with the Age Discrimination in Employment Act (ADEA)? Option A. Recommend a thorough analysis of the proposed benefit reduction's impact on employees aged 40 and over, exploring alternative cost-saving measures that do not disproportionately disadvantage older workers, and consulting with legal counsel regarding ADIA implications. Option B. Suggest that the company offer a smaller, less comprehensive benefit package to all employees, regardless of age, to achieve cost savings without targeting specific age groups. Option C. Proceed with the proposed reduction, assuming that any changes to benefits for future retirees are grandfathered and therefore not subject to ADIA scrutiny. Option D. Advise the employer to implement the proposed reduction in retiree health benefits as it applies to all future retirees equally and is driven by legitimate cost containment concerns. The correct answer is D. Advise the employer to implement the proposed reduction in retiree health benefits as it applies to all future retirees equally and is driven by legitimate cost containment concerns. Explanation. This scenario presents a professional challenge because it requires the Registered Employee Benefits Consultant (REBC) to navigate a complex interplay between plan design, employer objectives, and federal anti-discrimination laws, specifically the Age Discrimination in Employment Act (ADIA). The challenge lies in ensuring that benefit plan adjustments, even when seemingly driven by cost containment or administrative efficiency, do not inadvertently or intentionally discriminate against older workers. The REBC must exercise careful judgment to balance the employer's legitimate business interests with their legal obligation to protect employees from age-based discrimination. The correct approach involves proactively identifying potential ADIA implications during the plan design and amendment process and recommending modifications that mitigate age-related disparities. This approach is right because it aligns with the REBC fiduciary duty to act in the best interests of plan participants and beneficiaries, which includes ensuring compliance with all applicable laws. Specifically, the ADIA prohibits employers from discriminating against individuals aged 40 or older in all aspects of employment, including employee benefits. Therefore, any benefit plan change that disproportionately negatively impacts older workers without a legitimate, non-discriminatory business reason violates the ADIA. The correct approach prioritizes a thorough review of proposed changes, consultation with legal counsel if necessary, and the implementation of alternatives that achieve the employer's goals without violating the ADIA. An incorrect approach would be to proceed with benefit plan changes solely based on the employer's stated desire for cost savings or administrative simplification, without a comprehensive assessment of their impact on older employees. This fails to uphold the REBC responsibility to ensure legal compliance and protect plan participants. Such an approach risks exposing the employer to significant legal liability under the ADIA, including potential lawsuits, back pay, and other damages. Another incorrect approach is to assume that any benefit reduction or modification is permissible as long as it applies equally to all employees, regardless of age. While facially neutral policies are often a component of ADIA compliance, they do not absolve the employer or consultant from examining whether the policy has a disparate impact on a protected group. If a seemingly neutral change disproportionately harms older workers and is not justified by a reasonable factor other than age, it can still be discriminatory. A third incorrect approach is to rely on outdated plan documents or previous legal interpretations without considering current ADIA case law and regulatory guidance. The legal landscape surrounding employee benefits and age discrimination is dynamic. Failing to stay abreast of these changes can lead to noncompliance, even if the original plan design was once considered acceptable. The professional decision-making process for similar situations should involve a multi-step approach. 1. Understand the employer's objectives for the benefit plan change. 2. Conduct a thorough analysis of the proposed changes, specifically evaluating their potential impact on different age groups within the workforce. 3. Consult relevant federal laws, including the ADIA and any applicable state laws. 4. If there is any uncertainty or potential for ADIA violation, seek guidance from legal counsel specializing in employee benefits and employment law. 5. Propose alternative solutions that achieve the employer's objectives while ensuring compliance with the ADIA and protecting the interests of older workers. 6. Document all analyses, recommendations, and decisions made throughout the process. Question 12. Operational review demonstrates that a mid-sized employer is seeking to implement a new group health insurance plan. The employer has expressed concern about the projected premium rates and has asked the Registered Employee Benefits Consultant, REBC, to identify all potential factors that might be influencing these rates and to suggest ways to potentially reduce them, while ensuring compliance with all applicable U.S. regulations. The REBC is considering how factors such as the average age of the employee population, the gender distribution of employees, the predominant industry of the employer, the geographic location of the company's operations, and the general health status of the workforce might be impacting the proposed premiums. Which of the following represents the most appropriate approach for the REBC to take in advising the employer regarding these factors and their impact on premium rates? Option A. Recommend that the employer disregard the impact of health status and industry on premium rates, as these are often subjective and can lead to unfair pricing, and instead focus on negotiating based on employee count alone. Option B. Inform the employer that due to the Affordable Care Act, factors such as age and gender are no longer permissible considerations for premium setting in group health plans, and focus solely on negotiating with insurers for the lowest possible base rate. Option C. Explain to the employer that while age and location are generally accepted rating factors, gender and health status are prohibited considerations under current U.S. regulations for all group health insurance plans, and therefore should not be a focus of the premium discussion. Option D. Advise the employer that age, gender, industry, location, and health status are all legitimate factors that insurers use to assess risk and determine premium rates, and that the REBC will work to ensure the chosen plan is compliant with all U.S. regulations, explaining how each factor contributes to the overall cost. The correct answer is D. Advise the employer that age, gender, industry, location, and health status are all legitimate factors that insurers use to assess risk and determine premium rates, and that the REBC will work to ensure the chosen plan is compliant with all U.S. regulations, explaining how each factor contributes to the overall cost. Explanation. This scenario presents a professional challenge because an REBC must balance the fiduciary duty to their client with the principles of fair and equitable risk assessment. The core of the challenge lies in understanding how various demographic and lifestyle factors are legitimately used by insurers to predict risk and set premiums, while also ensuring that such practices do not lead to unfair discrimination or violate regulatory mandates. The REBC must navigate the complex interplay between actuarial science, ethical considerations, and legal compliance. The correct approach involves a thorough understanding of how each factor influences premium rates within the regulatory framework governing employee benefits in the United States. This means recognizing that age, gender, health status, and industry are generally permissible rating factors because they are directly linked to statistically demonstrable differences in risk and claims experience. Location can also be a factor due to variations in healthcare costs and utilization patterns. The REBC role is to educate the client on these legitimate rating factors and to ensure that the proposed plans and their associated premiums are based on sound actuarial principles and comply with all applicable laws, such as ERISA and the ACA. This approach upholds the REBC duty of care and loyalty by providing accurate, compliant, and cost-effective benefit solutions. An incorrect approach would be to dismiss or ignore the impact of health status on premium rates. While the Affordable Care Act, ACA, has limitations on how health status can be used for individual and small group plans, for larger employer groups, health status can be a significant rating factor, and ignoring it would lead to inaccurate premium projections and potentially unaffordable plans for the employer. Another incorrect approach would be to assume that all demographic factors are universally prohibited from influencing rates, while certain factors may be restricted in specific contexts, e.g., gender under the ACA for certain plans. Their use is often permissible if actuarially justified and legally compliant. For example, industry can be a valid rating factor if certain industries have demonstrably higher or lower risk profiles for specific benefits. Finally, an incorrect approach would be to solely focus on the lowest possible premium without considering the underlying risk factors and their regulatory permissibility, potentially leading to plans that are unsustainable or non-compliant. The professional decision-making process for similar situations requires a systematic evaluation of each factor presented. The REBC should first identify the relevant regulatory framework, in this case, U.S. federal and state laws governing employee benefits. Then, for each factor, the REBC must determine if it is a legally permissible basis for premium differentiation. This involves consulting actuarial data, insurer guidelines, and relevant legislation. The rep should then communicate these findings clearly to the client, explaining the rationale behind the rating factors and their impact on the overall cost of benefits, while also advising on strategies to manage risk and optimize plan design within legal and ethical boundaries. Question 13. Stakeholder feedback indicates that the employer sponsoring an ERISA-governed retirement plan is concerned about rising administrative costs and has requested a review of the current third-party administrators, TPA fees, suggesting they may be higher than market rates. As the registered employee benefits consultant (REP) responsible for advising on this plan, what is the most appropriate course of action to ensure ERISA compliance? Option A. Terminate the contract with the current TPA and solicit bids from new providers solely based on the employer's request to reduce costs, without a detailed evaluation of the current TPA's performance or the specific needs of the plan. Option B. Immediately inform the employer that their concerns are noted and proceed to renegotiate the contract with the current TPA based on their assertion of high fees, without further independent investigation. Option C. Conduct a thorough, documented review of the current TPA services and fees, benchmark them against industry standards, and explore potential alternative providers to determine if a more cost-effective solution that maintains or improves service quality is available. Option D. Advise the employer that as the rep, the decision on service providers rests solely with the plan sponsor, and that the rep will not intervene in fee negotiations. The correct answer is C. Conduct a thorough, documented review of the current TPA services and fees, benchmark them against industry standards, and explore potential alternative providers to determine if a more cost-effective solution that maintains or improves service quality is available. Explanation. This scenario presents a professional challenge because it requires balancing the fiduciary duty owed to plan participants with the practical realities of managing a plan's administrative costs. The rep must navigate potential conflicts of interest and ensure that decisions made are solely in the best interest of the plan beneficiaries, as mandated by ERISA. The pressure to reduce costs, while understandable from the employer's perspective, cannot override ERISA's stringent requirements for prudence and loyalty. The correct approach involves a thorough, documented review of the service provider's performance and fees, comparing them against industry benchmarks and exploring alternative providers. This aligns with ERISA fiduciary responsibilities, specifically the duty of prudence, 29 CFR Section 2550, 404A1, and the duty of loyalty, 29 CFR Section 2550, 404A1. ERISA requires fiduciaries to act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. This includes regularly reviewing service provider arrangements to ensure they remain reasonable and in the best interest of participants. Documenting this review process is crucial for demonstrating compliance. An incorrect approach would be to immediately terminate the existing service provider based solely on the employer's desire to cut costs without a proper evaluation. This fails to meet the duty of prudence, as it bypasses the necessary due diligence to determine if the current provider's fees are indeed unreasonable or if their services are subpar. It also risks violating the duty of loyalty if the decision is driven by the employer's interests rather than the participants' best interests. Another incorrect approach would be to accept the employer's assertion that the current provider is overcharging without independent verification, and then simply renegotiating the contract without a comprehensive review of services and alternatives. This approach may not achieve the best possible outcome for the plan and its participants, as it doesn't explore whether a different provider might offer better services at a comparable or lower cost, or if the current provider's fees are justified by the quality of service. It also fails to demonstrate the thoroughness required by the duty of prudence. Finally, an incorrect approach would be to ignore the stakeholder feedback and continue with the current service provider without any further investigation. This would be a direct breach of the fiduciary duty to monitor plan service providers and ensure that fees are reasonable and services are appropriate, potentially exposing the plan and its fiduciaries to liability. The professional decision-making process for similar situations should involve 1. Acknowledging and investigating all stakeholder feedback. 2. conducting a comprehensive and documented review of the existing service provider's performance, fees, and contract terms. 3. Benchmarking fees and services against industry standards and potential alternative providers. 4. Evaluating the impact of any proposed changes on plan participants and beneficiaries. 5. Making decisions based on the best interests of the plan participants, supported by objective analysis and documentation. Question 14. Stakeholder feedback indicates that a key employee, returning after a significant medical leave, is expressing concerns about their ability to immediately resume their full workload and demanding a phased return with modified duties, while the employer is eager for them to return to their previous responsibilities without delay to meet project deadlines. As a registered employee benefits consultant REBC, what is the most appropriate course of action? Option A. Suggest that the employee be assigned less demanding tasks that are readily available, regardless of their relevance to their original role, to keep them occupied while they get back into the swing of things. Option B. Advise the employer to insist on the employee returning to their full duties immediately as per their original job description to avoid setting a precedent for modified work arrangements. Option C. Recommend developing a personalized, phased return-to-work plan in collaboration with the employee, their healthcare provider, and HR, focusing on medically appropriate accommodations and gradual reintegration. Option D. Recommend that the employer inform the employee that failure to return to full capacity within a specified short time frame may result in disciplinary action or termination of employment. The correct answer is C. Recommend developing a personalized, phased return-to-work plan in collaboration with the employee, their healthcare provider, and HR, focusing on medically appropriate accommodations and gradual reintegration. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to manage costs and operational efficiency with the ethical and regulatory obligations to support employees returning to work after a health-related absence. The REBC must navigate potential conflicts of interest and ensure that recommendations align with best practices and relevant regulations, particularly those concerning employee well-being and non-discrimination. Careful judgment is required to avoid actions that could be perceived as punitive or that undermine the effectiveness of the return-to-work program. The correct approach involves advocating for a flexible, individualized return-to-work plan that prioritizes the employee's health and safety while facilitating a gradual and sustainable reintegration into the workplace. This aligns with the ethical duty of care owed to employees and the regulatory spirit of promoting a healthy and inclusive work environment. Specifically, this approach would involve collaborating with the employee, their healthcare provider, and HR to develop accommodations that are medically appropriate and operationally feasible, ensuring compliance with any applicable disability or accommodation laws. An incorrect approach that focuses solely on immediate full-time return without considering medical advice or employee capacity would fail to uphold the duty of care and could lead to a relapse, further absence, and potential legal repercussions for the employer. This disregards the principle of reasonable accommodation and could be seen as discriminatory. Another incorrect approach that prioritizes the employer's convenience over the employee's recovery, such as assigning tasks that are clearly beyond the employee's current capabilities, would also be ethically and regulatorily unsound. This demonstrates a lack of empathy and a failure to adhere to the principles of supporting employee well-being, potentially violating workplace safety and health regulations. Finally, an approach that involves pressuring the employee to return before they are medically cleared, or that discourages them from seeking necessary accommodations, would be a significant ethical and regulatory breach. This undermines the integrity of the return-to-work process and could expose both the employee and the employer to undue risk. Professional decision-making process for similar situations should involve a thorough understanding of the employee's medical situation, open communication with all relevant parties, a commitment to finding mutually agreeable solutions, and a steadfast adherence to regulatory requirements and ethical principles. The REBC should act as a trusted advisor, ensuring that the return-to-work program is both effective for the business and supportive of the employee's health and recovery. Question 15. The evaluation methodology shows that a registered employee benefits consultant, REBC, is reviewing a plan sponsor's rehabilitation and vocational services program. Which of the following approaches best aligns with the REBC fiduciary responsibilities under U.S. federal law and ethical obligations to plan participants? Option A. Prioritizing the reduction of short-term disability claim costs by limiting access to rehabilitation services without a thorough assessment of long-term impact on employee recovery and return-to-work outcomes. Option B. Conducting a comprehensive review of the Rehabilitation and Vocational Services Program, focusing on outcomes, cost-effectiveness, and compliance with relevant U.S. Department of Labor regulations to ensure services are reasonably designed to support employee recovery and return to work. Option C. Solely relying on the plan sponsor's internal cost-saving reports for the rehabilitation program, without independent verification or consideration of participant well-being and service quality. Option D. Recommending the immediate termination of the rehabilitation program based on a preliminary cost analysis, without evaluating its effectiveness in facilitating employee return to work or its potential impact on long-term disability costs. The correct answer is A. Prioritizing the reduction of short-term disability claim costs by limiting access to rehabilitation services, without a thorough assessment of long-term impact on employee recovery and return-to-work outcomes. Explanation. The evaluation methodology shows that a registered employee benefits consultant (REBC) is tasked with assessing the effectiveness of rehabilitation and vocational services offered by a plan sponsor. This scenario is professionally challenging because it requires the REBC to balance the plan sponsor's desire for cost containment with the fiduciary duty to ensure that benefits provided are adequate and appropriate for plan participants, particularly those recovering from injury or illness. The REBC must navigate complex regulations, ethical considerations, and the practical realities of rehabilitation services to make informed recommendations. The correct approach involves a comprehensive review of the Rehabilitation and Vocational Services Program, focusing on outcomes, cost-effectiveness, and compliance with relevant U.S. Department of Labor (DOL) regulations, particularly those pertaining to fiduciary responsibilities under the Employee Retirement Income Security Act of 1974, (ERISA). This includes evaluating whether the services provided are reasonably designed to help employees return to work or achieve maximum functional capacity, thereby minimizing long-term disability claims and associated costs. The REBC must also consider the quality of providers, the accessibility of services, and the overall impact on employee well-being and productivity. This aligns with ERISA requirement for fiduciaries to act solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. An incorrect approach would be to solely focus on the cost savings achieved by the rehabilitation program, without a thorough assessment of its impact on employee recovery and return-to-work rates. This fails to meet the fiduciary standard of acting in the best interest of participants, as it prioritizes cost over the provision of necessary and effective services. Another incorrect approach would be to rely solely on anecdotal evidence or the plan sponsor's internal reports without independent verification or benchmarking against industry best practices and regulatory guidance. This could lead to overlooking deficiencies in the program that may violate ERISA or negatively impact participants. A further incorrect approach would be to recommend the termination of a rehabilitation program based on a superficial cost-benefit analysis, without considering the potential long-term increase in disability costs and the ethical obligation to support employees through their recovery. Professional decision-making in such situations requires a systematic process. First, understanding the specific regulatory landscape, ERISA in this case, and its implications for benefit plan design and administration. Second, gathering objective data on program performance, including return-to-work rates, duration of disability, and participant satisfaction. Third, evaluating the program's alignment with the plan's objectives and the needs of its participants. And finally, making recommendations that are both compliant with regulations and ethically sound, ensuring that the plan provides value to both the sponsor and its employees. Question 16. What factors determine the suitability of a self-funded employee benefit plan for an employer, considering the REBC fiduciary responsibilities under U.S. federal law? Option A. The ease with which the plan can be implemented and the perceived simplicity of managing claims without an insurance carrier. Option B. The employer's financial stability, historical claims experience, and capacity to absorb potential claim fluctuations, alongside a clear understanding of the regulatory requirements for self-funded plans. Option C, the projected annual savings in premium taxes and the potential for the employer to invest surplus funds. Option D, the employer's stated preference for lower administrative fees and the availability of third-party administrators to manage the plan. The correct answer is B, the employer's financial stability, historical claims experience, and capacity to absorb potential claim fluctuations, alongside a clear understanding of the regulatory requirements for self-funded plans. Explanation: this scenario is professionally challenging because an REBC must balance the employer's desire for cost control and flexibility with the fiduciary duty to ensure the plan design adequately protects employee benefits and complies with all applicable regulations. The decision to recommend a self-funded arrangement requires a thorough understanding of the employer's financial stability, risk tolerance, and the potential impact on plan participants. Careful judgment is required to avoid recommending a structure that, while potentially cheaper in the short term, could lead to significant financial strain for the employer or inadequate coverage for employees. The correct approach involves a comprehensive assessment of the employer's financial health, historical claims data, and projected future costs, alongside an evaluation of the employer's capacity to absorb potential fluctuations in claims. This approach is correct because it aligns with the REBC fiduciary responsibilities under ERISA, Employee Retirement Income Security Act of 1974, which mandates acting solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. Specifically, recommending self-funding without a robust financial assessment could violate the prudence requirement and the duty to act in the best interest of participants, as it could expose the plan to undue financial risk. An incorrect approach would be to recommend self-funding solely based on the employer's stated desire to reduce administrative costs without a thorough analysis of the employer's ability to manage potential claim volatility. This is a regulatory failure because it prioritizes the employer's immediate cost-saving objective over the long-term financial security of the employee benefit plan and its participants, potentially violating ERISA fiduciary duties. Another incorrect approach would be to proceed with recommending self-funding without fully disclosing the inherent risks and responsibilities associated with such arrangements to the employer. This is an ethical and regulatory failure, as it omits crucial information necessary for the employer to make an informed decision, potentially leading to future disputes and a breach of the REBC duty of care and disclosure. A third incorrect approach would be to recommend a self-funded plan that utilizes stop-loss insurance without adequately explaining the limitations and coverage triggers of the stop-loss policy. This is a failure in professional judgment and disclosure, as it could lead to the employer misunderstanding the extent of their financial exposure, thereby not fulfilling the REBC obligation to provide clear and comprehensive advice. The professional decision-making process for similar situations should involve a systematic evaluation of the employer's financial capacity, risk tolerance, and operational capabilities. This includes conducting a detailed feasibility study, analyzing historical claims data, projecting future costs under various scenarios, and thoroughly explaining the advantages and disadvantages of self-funding, including the employer's responsibilities for claims payment, administration, and potential reserve requirements. The REBC must also ensure that any recommended stop-loss coverage is appropriate and clearly understood by the employer. Transparency and a commitment to the long-term well-being of the plan and its participants should guide every recommendation. Question 17. Examination of the data shows an employer is proposing to implement a new group disability insurance policy with a 30-day elimination period and a benefit duration of 2 years for all eligible employees. As a registered employee benefits consultant REBC, operating under U.S. federal and state insurance regulations, what is the most appropriate action regarding these proposed terms? Option A. Advise the employer that while these terms are common, it is crucial to confirm they meet or exceed any statutory minimums for elimination periods and benefit durations mandated by applicable U.S. federal and state laws, and to clearly explain the implications of these specific terms to the employees. Option B. Recommend shorter elimination periods and longer benefit durations to maximize employee benefit access, regardless of the employer's cost considerations or specific plan objectives. Option C. Immediately approve the proposed terms as they represent a standard offering in the market, assuming they are legally compliant without further verification. Option D. Focus solely on the cost-effectiveness of the proposed 30-day elimination period and 2-year benefit duration, advising the employer that these terms are likely acceptable from a financial perspective. Correct answer is A. Advise the employer that while these terms are common, it is crucial to confirm they meet or exceed any statutory minimums for elimination periods and benefit durations mandated by applicable U.S. federal and state laws, and to clearly explain the implications of these specific terms to the employees. Explanation. This scenario is professionally challenging because it requires the registered employee benefits consultant (REBC) to navigate the complexities of benefit duration and elimination periods, which directly impact employee access to benefits and the financial implications for both the employer and the insurer. Misinterpreting or misapplying these provisions can lead to significant financial hardship for employees, potential legal liabilities for the employer, and reputational damage for the consultant. Careful judgment is required to ensure compliance with regulatory frameworks and to advise clients accurately on the implications of different plan designs. The correct approach involves clearly explaining to the employer the statutory minimums and common practices for benefit duration and elimination periods, as defined by relevant U.S. federal regulations, such as ERISA and the ACA, and state insurance laws. This includes detailing how these periods function, their impact on when benefits become payable after a qualifying event, and the maximum duration benefits can be provided. This approach is correct because it prioritizes accurate, compliant, and client-centered advice, ensuring the employer understands their obligations and the employee's rights under the law. It upholds the REBC ethical duty to act in the best interest of their clients and to provide competent advice. An incorrect approach would be to simply accept the employer's proposed benefit duration and elimination periods without verifying their compliance with applicable laws. This fails to meet the REBC professional responsibility to ensure that benefit plans are legally sound and do not inadvertently disadvantage employees. It could lead to the employer offering a plan that violates regulatory requirements, exposing them to penalties and legal action. Another incorrect approach would be to focus solely on the cost savings of shorter elimination periods or longer benefit durations, without adequately explaining the trade-offs in terms of employee access to benefits and potential increases in premium costs. This prioritizes a narrow financial objective over the comprehensive understanding and well-being of the employer's workforce, which is a core responsibility of an REBC. It neglects the ethical obligation to provide balanced advice that considers all relevant factors. A third incorrect approach would be to assume that industry-standard practices automatically equate to legal compliance. While industry standards can be informative, they do not supersede legal requirements, and REBC must always verify that any proposed plan design meets or exceeds the minimum standards set by federal and state regulations. Failure to do so constitutes a dereliction of professional duty. The professional decision-making process for similar situations should involve a thorough review of the employer's proposed benefit plan provisions against all applicable federal and state laws and regulations. This includes understanding the definitions and requirements for elimination periods and benefit durations. The REBC must then clearly communicate these legal requirements and their implications to the employer, offering options that are both compliant and aligned with the employer's objectives, while also considering the impact on employees. Transparency, accuracy, and a commitment to regulatory compliance are paramount. Question 18. When evaluating a defined benefit pension plan sponsored by a financially struggling company, what is the most critical action an REBC must take regarding Pension Benefit Guaranty Corporation, PBGC, insurance? Option A. Recommend that the plan sponsor explore ways to reduce the plan's benefit liabilities without regard to PBGC insurance requirements. Option B. Proactively assess the plan's funded status and ensure all PBGC premiums are paid accurately and on time, while advising on potential funding improvement strategies or compliant termination procedures. Option C. Advise the plan sponsor to cease PBGC premium payments until the company's financial situation improves. Option D. Focus solely on the company's immediate cash flow needs and defer any discussions about PBGC obligations until the company is financially stable. The correct answer is B. Proactively assess the plan's funded status and ensure all PBGC premiums are paid accurately and on time, while advising on potential funding improvement strategies or compliant termination procedures. Explanation: this scenario presents a professional challenge because an REBC must navigate the complex interplay between a plan sponsor's financial distress and the PBGC mandate to protect defined benefit pension plan participants. The REBC duty is to provide accurate, compliant advice, even when the information is difficult for the plan sponsor to hear. The PBGC insurance requirements are not optional. They are a critical component of the regulatory landscape for covered pension plans. The correct approach involves proactively assessing the plan's funded status and understanding the implications of PBGC insurance premiums and potential liabilities. This requires the REBC to thoroughly review the plan's financial health, including its funding levels, investment performance, and actuarial assumptions. By identifying potential underfunding early, the REBC can advise the plan sponsor on strategies to improve funding, explore plan termination options in compliance with PBGC regulations, and ensure all premium payments are made accurately and on time. This proactive and compliant stance directly aligns with the REBC fiduciary responsibilities and the regulatory framework governing employee benefits, specifically the Employee Retirement Income Security Act, ERISA, as it pertains to PBGC insurance. An incorrect approach would be to ignore or downplay the plan's underfunded status and the associated PBGC obligations. This failure to address the financial realities of the pension plan and the implications of PBGC insurance premiums could lead to significant penalties, interest, and increased liability for the plan sponsor if the plan eventually needs to be terminated and trusteed by the PBGC. Another incorrect approach is to advise the plan sponsor to cease premium payments, which is a direct violation of ERISA and PBGC regulations, and would expose both the plan sponsor and potentially the REBC to severe legal and financial repercussions. Furthermore, advising the plan sponsor to misrepresent the plan's financial condition to the PBGC would constitute fraud and a breach of ethical and legal duties. Professionals should approach such situations by prioritizing regulatory compliance and participant protection. This involves a systematic review of plan documents, financial statements, and actuarial reports. When potential issues arise, such as underfunding or missed premium payments, the REBC must clearly and candidly communicate the risks and regulatory requirements to the plan sponsor. The decision-making process should always be grounded in a thorough understanding of ERISA, PBGC regulations, and the REBC Professional Code of Conduct, emphasizing transparency, accuracy, and proactive problem-solving. Question 19. Benchmark analysis indicates that a significant number of employees in a large corporation are unaware that their employer-sponsored long-term disability, limited benefit payments are reduced by the amount of Social Security disability benefits they receive. The employer has recently asked the REBC to review the limited plan documents and ensure that the integration with Social Security is being applied correctly, and to explore options for communicating this integration more effectively to employees, while also ensuring compliance with workers' compensation offsets. What is the most appropriate course of action for the REBC? Option A. Recommend that the employer cease applying the Social Security offset to the limited benefits to avoid employee dissatisfaction, even if it means increasing the employer's benefit costs. Option B. Advise the employer to only apply the Social Security offset if an employee specifically inquires about it, rather than proactively disclosing it in general communications. Option C. Advise the employer to implement a clear and comprehensive communication strategy that explains the Social Security offset and any applicable workers' compensation integration to employees, ensuring all plan documents and summary plan descriptions are updated to reflect these provisions accurately. Option D. Suggests that the employer inform employees that their limited benefits will be reduced by Social Security, but without providing specific details on how the calculation is performed, to avoid overwhelming them with complex information. The correct answer is C. Advise the employer to implement a clear and comprehensive communication strategy that explains the Social Security offset and any applicable workers' compensation integration to employees, ensuring all plan documents and summary plan descriptions are updated to reflect these provisions accurately. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to manage benefit costs with the ethical obligation to ensure employees receive the full intended value of their benefits, particularly when those benefits are designed to supplement or coordinate with government programs. The REBC must navigate the complexities of integration rules and disclosure requirements to avoid misleading plan participants or violating regulatory mandates. Careful judgment is required to ensure transparency and compliance. The correct approach involves proactively identifying and clearly communicating to employees how their employer-provided disability benefits will be offset by Social Security disability payments. This aligns with the regulatory framework governing employee benefit plans, which emphasizes transparency and accurate disclosure to participants. By providing this information upfront, the REBC ensures employees understand the net benefit they will receive, preventing potential misunderstandings or financial surprises. This approach upholds the ethical duty of care and the fiduciary responsibility to act in the best interests of plan participants by providing complete and accurate information. An incorrect approach would be to simply implement the offset without informing employees. This failure to disclose the integration of Social Security benefits with the employer's plan constitutes a violation of disclosure requirements under relevant regulations. Employees are entitled to understand the full terms and conditions of their benefits, including any reductions. Another incorrect approach would be to misrepresent the offset as a separate benefit or to downplay its impact. This constitutes misleading communication and a breach of ethical conduct, as it creates a false impression of the total benefit available. Furthermore, failing to integrate workers' compensation benefits correctly, if applicable, could lead to either overpayment by the employer or underpayment to the employee, both of which are regulatory and ethical failures. Professionals should approach such situations by first thoroughly understanding the plan documents and the specific integration provisions. They should then consult the relevant regulatory guidance to ensure compliance with disclosure and communication standards. A key step in professional decision-making is to anticipate potential employee confusion and proactively address it through clear, concise, and comprehensive communication. This involves developing communication materials that explain the offset mechanism in plain language, providing examples, and offering avenues for employees to seek further clarification. The REBC role is to facilitate informed decision-making by employees regarding their benefits. Question 20. Market research demonstrates that a significant number of participants in a large defined contribution plan are confused about the vesting schedules for their employer contributions, as the summary plan description, SPD, appears to differ in key details from the formal plan document. As a registered employee benefits consultant rep with fiduciary responsibilities, what is the most appropriate course of action? Option A. Advise participants to disregard the SPD and rely solely on the formal plan document for vesting schedule information. Option B. Wait for participants to raise specific questions about vesting schedules before investigating the discrepancies. Option C. Initiate a formal review process with the plan sponsor to reconcile the differences between the plan document and the SPD, and then ensure accurate communication to participants. Option D. Immediately inform participants of the potential discrepancies and advise them to consult the formal plan document for clarification. The correct answer is D. Immediately inform participants of the potential discrepancies and advise them to consult the formal plan document for clarification. Explanation. This scenario is professionally challenging because it requires an rep to navigate the complex interplay between ERISA fiduciary duties and the practical realities of plan administration, specifically concerning the timely and accurate provision of information to plan participants. The rep role as a fiduciary means they must act solely in the interest of plan participants and beneficiaries, exercising prudence and diligence. Failure to provide accurate and timely information can lead to participant confusion, incorrect benefit elections, and potential legal challenges against the plan sponsor and the rep. The correct approach involves proactively identifying and addressing potential discrepancies in plan documents and summary plan descriptions, SPD, before they impact participants. This demonstrates prudence and loyalty, fulfilling the fiduciary obligation to ensure participants receive clear and accurate information about their benefits. Specifically, The REBC should initiate a review process with the plan sponsor to reconcile any differences between the formal plan documents and the SPD, and then ensure that any necessary corrections are communicated to participants in a timely manner, aligning with ERISA disclosure requirements. This proactive stance minimizes the risk of participant harm and regulatory noncompliance. An incorrect approach would be to simply rely on the existing SPD without verifying its accuracy against the plan document. This fails to exercise the required prudence and diligence, as the SPD is intended to be a summary of the plan, and discrepancies can lead to misinterpretations. It also risks violating ERISA disclosure rules if the SPD is materially inaccurate. Another incorrect approach would be to inform participants of the potential discrepancies without first attempting to resolve them with the plan sponsor. While transparency is important, providing incomplete or unverified information can cause undue confusion and anxiety among participants, potentially leading them to make uninformed decisions. The REBC duty is to provide accurate information, which implies a responsibility to ensure that information is accurate before disseminating it. A further incorrect approach would be to delay addressing the discrepancies until a participant specifically inquires about them. This passive stance fails to meet the fiduciary standard of proactively safeguarding participant interests. ERISA requires timely disclosure, and waiting for a participant inquiry may mean that crucial information is not provided when it is most needed, potentially impacting benefit elections or other critical decisions. Professionals should adopt a decision-making framework that prioritizes participant interests and regulatory compliance. This involves a continuous cycle of assessment, verification, and communication. When potential issues arise, the REBC should first assess the nature and potential impact of the issue. Then, they should diligently verify the accuracy of information and reconcile discrepancies with the plan sponsor. Finally, clear, accurate, and timely communication with participants should be the ultimate goal, ensuring they have the information necessary to make informed decisions about their benefits.